Whether you're dreaming of a retirement with sand between your toes and a cold one in your hand, hitting the road to chase the winds of adventure, or spending time with your grandchildren, this show is intended to help you get there. Welcome to Coasting in Retirement with your host, Josh Knoll. You've worked too hard throughout your career to spend your retirement worrying. So sit back and kick up your feet because we've got lots of financial tips and tricks to share to help you get exactly where you want to be. Here's Josh.
Hello, Lower Alabama. Hello, Gulf Coast. Welcome in. Welcome to Coasting in Retirement. Thanks for joining us today. Josh Knoll here alongside returning co-host Michelle Lee Milton-Knoll.
Well, I haven't been here in a sec.
Yeah, I know. You've been gone a couple weeks.
Whose fault is that?
Probably mine. Well, glad to have you back. We're here in Coastal College's recording studio, beautiful downtown Fairhope, putting together what we hope is another great show for those of you tuning in, a brand new show. Listeners, Michelle and I are here today to discuss financial topics relevant to those of you in or near retirement, living your best life along our part of the Gulf Coast. Here's what we got in store. First segment, I'm going to do a deep dive on our topic of the day. Second segment, about 30 minutes past the hour, we'll have headlines of the week. And then roughly 50-ish minutes past the hour, stick around for our third segment. We call it Josh's Crystal Ball and Big Mouth. So buckle up, we got a lot to get to. Quick background on me for those of you new to the show. Again, my name is Josh Knoll. I'm a fee-based financial advisor. I hold my FINRA Series 65 securities license, and I'm the owner of Gulf Coast Financial Advisors. That is a 100% locally owned, 100% independent investment management and financial planning firm. We have offices in downtown Fairhope, Orange Beach, and Mobile. You can find more information on me and the team at Gulf Coast Financial Advisors by visiting our website, gulfcoastfa.com, or feel free to give us a call anytime, 251-327-2124. Now, if you just missed that contact info, grab a pen, grab a pad, grab your phone, grab whatever you need. Get ready to write it down. We're going to repeat it several times throughout the show. Speaking of the show, Michelle, as we kick the show off, I got a couple questions to you. So we set the table for our topic of the day.
All right.
First question. What is money?
Okay, well, something considered of value. It's exchanged for goods and services.
I mean, I think that's probably the basic economic of it, right?
Right.
How is money produced?
Physically by mints, if they're
you
still
think?
around. I mean, physical paper and coin money, yeah.
Oh.
Sans pennies.
Buckle up. We got a lot to talk.
There's physical money in my wallet right now.
This is true.
And but if it comes to like the Bitcoin stuff, I have no idea how it's produced.
All right. Well, today we're going to talk about the history of money. That's our topic for the day, particularly the history of the U.S. dollar, and more importantly, why money and what's called monetary policy matter so much to investors. So I'm going to need your help pronouncing this word because it's got more than 3 syllables. If you go back to ancient Mesopotamia, am I saying that right?
Yeah, Mesopotamia.
Yeah, so that would be kind of, what would that be, where Uruk would be now? Iran? Is that kind of where Okay,
yeah.
All right. So
Biblical,
right. If you go back to ancient Mesopotamia, they weren't always swapping. Most people think about they were swapping gold, right, for paying people back and forth.
I don't know. I mean, I think they were swapping
Trading
shells
stuff.
and incense and other things, too.
They may have moved beyond that. But did you also know that they used clay tablets to record debts?
I have seen those in museums over there, correct.
That's very good. So money started as what's called a ledger system.
Okay.
Now, fast forward a few thousand years, and we moved to what's called commodity money, like Michelle mentioned, that things like gold and silver that had intrinsic value, think Roman coins, if you will.
Oh, yeah.
But the big shift for our listeners...
Or the Spanish galleon coins.
Very good, yes. Didn't they just find a bunch of that in a shipwreck?
Yeah, always.
That's right. Well, a big shift for our listeners' portfolios. For those of y'all that were alive in 1971, you remember when we came off the gold standard, that had been Nixon, and we officially broke the link between the U.S. dollar and gold.
Okay. Time out.
That's good.
So Wizard of Oz had something to do with moving away from gold money and using paper money.
How's that?
That's what it's about.
Oh, is it?
Yeah,
Well,
about the Industrial Revolution.
Okay.
And that's why the Emerald City, and it was all gold and stuff. I mean, you didn't know about this?
I did not, no.
Yeah, that's what he wrote it. That's what Frank Baum wrote it about.
That's amazing.
Yeah,
All
you
right.
should look into that.
The other one is...
I think we had a whole class of it in college.
What's the Christmas movie where the bank is about to go under... oh, good grief.
Beautiful Life.
I think so, yeah.
Well, It's a Wonderful Life.
Wonderful Life, yeah. There's going to be some things we talk about with that. But in 1971, we came off the gold standard. We moved from what is called representative money to what is called fiat money. And what that means is that...
Like fiat? Like the
fiat,
car?
That's right, yes. Fiat money.
The little pregnant roller skate car?
Well, that's help you remember it. But fiat money has value simply because the government says it does, and we all agree to use it. All right? That's fiat money. Now, I'm going to melt our listeners' brains even a little bit more. Money is not an object. It's a social contract. It's a ledger of who owes what to whom. This is, Michelle mentioned a second ago, crypto. This is one of the reasons that crypto has had such severe ups and downs, because there hasn't been consensus around the social contract with crypto like there is with money, at least not yet. We'll see how that goes, right? So understanding how money is created is like pulling back the curtain on a play, or the
Wizard of Oz.
That's right. Most people think that the government prints every dollar at a physical press. But in our modern 2026 economy, the printing press is actually a digital ledger shared between two main players. That's a central bank and commercial banks. Are you with me so far?
Kind of, but there are still mints that print money.
There are, but it's less important than it ever has been. All right?
Okay.
So we'll start with the central bank, the Federal Reserve. That's been on the news constantly, so most people recognize that. The Federal Reserve doesn't just print paper, it creates what's called bank reserves. When the Fed wants to increase the money supply, it engages as what they call open market operations, or for you really want to get nerdy, quantitative easing.
That sounds made up.
That's a term that came out of 2008 and it reappeared in COVID, right? So here's the process. The government will buy, the Fed will buy government bonds from big banks. To pay the magic, if you will, to pay for these bonds, the Fed will simply type a new balance into the selling bank's digital reserve account. No physical money will move. A digital entry is created out of thin air. This is the base money that supports the rest of the system. Okay,
This
got it?
sounds a lot like Wizard of Oz.
Exactly. It kind of is when you,
Yeah.
you stay.
Sounds like seems to be a lot of room for error and corruption.
Well, stay with us, listeners, because you're going to learn a lot today. The other part of that is, we mentioned, is the commercial bank, which we're going to refer to as the credit factory. Most people don't understand that about 90% of the money that they actually spend is created by commercial banks. I'm going to say that again. 90% of the money you actually spend is created by commercial banks.
The credit factory.
Right? So unlike most people, banks don't just lend out the money that other people deposited. Again, It's a Wonderful Life. We learned this way back then, right? Instead, they create new money every time they issue a loan. Here's how it works.
Okay.
So let's say you take out a $500,000 mortgage.
All right.
The bank doesn't just take $500,000 from a vault. They credit your account with $500,000, and then they record a $500,000 debt on their books. At that exact moment, the money supply has increased by $500,000. Did you know that?
I did not know that, and all this just I don't know, keying stuff in without being backed by anything is frightening.
Right? That new money, so the money, I'm buying a house from Michelle. I give her, she gets the $500,000. I get the house. That $500,000 they did not go back in their vault and count out $500,000. They made a digital entry, right? Then, so again, what this means is that loans and money is essentially a ledger of debt. On the creation, when a loan is made, money is born.
Oh, that's sweet.
Now, on the other side of that, the destruction of money, if you will, when you pay off a loan,
Yay.
that money is actually, quote unquote, destroyed.
Boo.
It disappears from the bank's ledger, and the total money supply shrinks. But guess what? America has not paid off their debt faster than they've created new debt in a long, long time. We're going to talk about that too. Now, here's why it matters to your 2026 portfolio. Because most of the money is created through lending, the cost of money, or otherwise what you refer to as interest rates, is the most important lever in the world. For example, if you have low rates, let's say that the Fed sets a rate lower, that encourages more borrowing, which means more money is printed and put into the economy, which means that often you have higher asset prices like in stocks and real estates, right?
Okay.
Then you always hear the Fed is trying to cool inflation, so they raise rates. Why did they do that? Because it slows down borrowing, which effectively puts the money factory on a break, leading to less money in the system, less liquidity, and potentially a cooling of the markets. Now, we haven't seen that as much. And rates right now, I don't know what the Fed rate is at right now. It's historically not that high. The intention was to cool the economy a little bit and knock down inflation. That hasn't necessarily worked yet, so that's why there's all this debate going on about what they should do with rates. But there is one fun little note before we go to our next little piece here. If everyone in the world paid off their debts tomorrow or today, there would be almost no money left in circulation.
Ooh.
We would live in a we live in a debt-based monetary system.
sad.
Which is why understanding the ledger, the ledger is the first step to becoming a truly educated and sophisticated investor. In simplest terms, again, why this matters, because this all impacts inflation, which is, I mean, would you agree that inflation is a hot topic?
Sure.
Across
Yeah.
multiple spectrums,
Yeah.
particularly politically right now. Inflation occurs when the growth of the money supply outpaces the growth of the economy's ability to produce goods and services. For example, if you double the number of ledger entries, i.e. dollars, in the world, but you don't double the number of houses or cars or gallons of milk or whatever, each individual dollar represents a smaller slice of the total economic pie. There is more money chasing the same amount and sometimes lesser amount of goods. That's why everybody remembers this. You know, some of y'all maybe weren't born around 1971. Michelle and I weren't yet. But this is why everybody remembers 2021. The massive money supply that we saw in 2020, 2021 during COVID, we saw the highest inflation rates in over 40 years in 2022. Remember that? Mm-hmm. Okay. But it's not just the COVID years that are an issue. Since 1975, when I was born, the U.S. monetary supply hasn't just grown, it has undergone a vertical leap transformation. In January of 1975, which more specifically is exactly when I was born.
That's true.
Right? The money supply was approximately $1 trillion, a little over $1 trillion.
All right.
All right? As of April 2026, the money supply has reached almost $23 trillion in the
Wow.
time that we've been alive. I'm a little bit older than
that's
you.
our whole entire lives.
Yes, a little bit older than you, but the numbers are about the same. So what's that mean? Let's break that down. That's a money explosion. About $22 trillion.
I want some money.
Right? About $22 trillion of money has been added to the system over the last 50 years. By a percentage increase, that is 2,146%. So let's just call it
Dang.
2,000% increase.
Okay.
And then what has happened is there's an increase in velocity of this. It took about 30 years, about 30, 31 years from 1975 to around 2006 for the money supply to grow by its first $6 trillion. In contrast,
Just in time to go kersplat.
right. Well, part of that was the easing, they kept the rates artificially low. You saw the run up in real estate,
Yeah,
right?
yeah, the balloon mortgages.
And you were living where in 2006?
Chattanooga?
Chattanooga. Houses were going crazy there
Yeah.
then, right?
Yeah.
Across the nation, right? And then, like you said, it went kersplat. In contrast, that $6 million over 31 years, in the 2020 pandemic era alone, the money supply increased by $6 trillion in just 2 years. Okay? Why did it accelerate so fast? So again, 75 to 2008, you got kind of a steady climb. We're getting used to coming off the gold standard. There was a lot of inflation. I was just old enough to remember high interest rates during, I believe it was Carter years, where they were trying to knock down inflation because it's gotten pretty high. That was driven mostly by commercial bank lending. As the economy expanded, people took out more mortgages and business loans. The ledger kind of grew at a relatively predictable rate. Then, fast forward to what you just mentioned earlier, Michelle, 2008, kersplat. That's when they introduced quantitative easing. After what's referred to as the Great Financial Crisis or the Great Recession, however you want to refer to it, the Federal Reserve began buying bonds indirectly. And what they would do is they are injecting base money into the system to keep the gears turning. Now, the difference between what they did then and what they did during COVID is they gave the banks primarily that money back in 2008. You recall that? Mm-hmm. Whereas COVID, they put the money directly in the
To
hands.
our pockets.
Right. Either way, they increased inflation. No matter the money was
Where
new
it
money.
went.
Right.
Right.
Then from 2020 to now, you've got, if you were to look at a chart, it's basically vertical. It's a combination of massive fiscal stimulus, or i.e. government spending, and a very aggressive monetary supply, which is Fed buying. It has led to the largest percentage increase in the money supply in U.S. history.
Bam.
2020 to 2026. There was a little bit of a contraction in 2023 when we raised rates because inflation got a little hairbally there, but and it has supplies a little bit, but it's still increasing. If you look at the monetary supply in the last 40 years, on average, it increased by around 8% every year. Last year, or this year, we're on a pace for 5%, but we're still increasing the monetary supply very, very significantly.
So the trajectory is probably still going to go up?
I mean, we're going to talk about that.
Okay.
All right. So we mentioned earlier there was over a 2,000% increase in the supply of money, right?
Okay.
Here's some main takeaways for your portfolio as we start landing this plane. This is one of the reasons why the buy and hold strategy of holding cash is effectively a guaranteed loss of purchasing power. It's why, JD, I don't mean to speak for him, but he's been on this radio show. JD Gardner of Aptus Capital Advisors and I both agree when we say that people need to reconsider what they think is a quote-unquote safe investment. When the supply of ledger entries, i.e. new money, increases by 20-fold, but you don't have a corresponding 20-fold increase of goods and services bought or available to buy, the price of those goods and services increase sometimes exponentially, as we've seen with the stock market, and to a lesser degree, the housing market. Does that make sense? Mm-hmm. Okay. That's one of the reasons we focus on, at Gulf Coast Financial Advisors, we focus on real assets. Whether it's stocks of companies with pricing power, or for you all that like to invest in real estate, you want to own the things that the money factory can't print. Since 1975, the stock market has significantly outpaced the growth of the money supply, again, illustrating why being an owner of productive assets is so critical to long-term wealth versus holding something like cash, which is intentionally being devalued.
I still want the bags of cash buried.
Right.
Or hidden or squirreled away.
I understand.
And get you out of a jam.
And
not your little ledgers.
There's all there is a saying, cash is king, obviously.
Yeah.
It's really, the thing is holding cash over an extended period of time, right? There's been countries in South America, for example, where what you could buy in the morning would radically change by the afternoon. We haven't had that here yet, but over the long term, we have that basic same effect. What has that done to the stock market indexes, right? This will, I think, really open your all's eyes with what we're trying to say here. In January of 1975, again, when I was born, the Dow Jones Industrial Average, which is an average valuation of around 30 companies that are picked, it was 632 points. Got that? 632 points. It is now over 50,000 points. Not $50,000 like somebody said. Sure. 50,000 points. Mm-hmm. That is it's almost 8,000% increase in that time period, my lifetime. Mm-hmm. The S&P 500, which probably more people are familiar with, its index average in January of 1975 was around 70. Look at your news today. It's somewhere around 7,500, give or take, depending on when you listen to this show. That is over a 10,000% increase. So if you put those numbers, let's be specific on the Dow Jones, 7,773% increase over that time period. S&P 500 was 10,438%. The monetary supply during that same time period increased 2,146%. So what does that tell you, Michelle? What if you were to take those numbers and say, how do I stay ahead of this 2,146% increase in monetary supply, which means that my purchasing power has gone down significantly? What do you do?
I guess you got to invest in some things.
Possibly. So think about this. When the money supply grew by 21x, easier way to put it, S&P grew by over 100x. So what that means is the social contract of the stock market, i.e. owning a piece of corporate of stocks, of American ingenuity, whatever it may be, was a far better store of value over that time period than just holding the currency itself. That's a pretty rare thing in the history of mankind, okay? Second thing is the power of compounding. These returns represent a massive wealth gap between those who saved cash and played it quote-unquote safe, and those who invested in the ledger of productivity. The S&P 500 shows the power of diversification across the 500 largest companies in the world, right? And they select those. That's Standard & Poor's 500. So fast forward to 2026. Even with all the quote-unquote hot inflation data that we've seen recently in April 2026, I think the CPI came in a little bit under 4%. The historical record shows that over the long-term period, the stock market, as opposed to cash or CDs or money market or anything like that, the stock market over that long time period has been the ultimate hedge against the expansion of money supply. Now, we'd be remiss not to say that all investing involves risk, right?
Yes.
And during that time period, cash, if you took the value of $1 and put it on a chart and you charted it over the last 50 years we've been talking about, what you would see is a relatively slow, straight line down and to the right. But what you wouldn't see is a lot of up and down in it. It's not like, again, we reference South America, not to pick on them, but they would have instances where, let's just say 1 unit of measurement of money would be worth 50% less by the time it got to the evening. And they had what's called hyperinflation. We haven't had that. What we've had, as far as the value of money, what your purchasing power is of your dollar, has been on a slow, steady decline down and to the right. Contrast that with what you see in the stock market. You've seen almost like a roller coaster, particularly in certain years. Easy to name some of those years, 2000, dot-com bust, 2008, the housing market crash, COVID crash, whatever it may be. But the overall trend has been up and to the right. And if you overlay those two charts next to each other, it's a pretty stark reminder. It shows you where did that 2,000% find its way to? Well, kind of found its way to assets like the stock market, okay?
All
right, so Michelle, I'm going to ask you this question first as we're closing this segment. Then I'm going to repeat it to the listeners, okay? Does seeing the 10,000% jump in the S&P 500 change how you think about the risk, quote-unquote risk, of the market versus the risks of staying in cash?
Okay, I mean, I feel more confident about the market and its stability. However, it seems to some extent to me still a little bit of make-believe.
It kind of all is to some degree.
I know. And so
right?
that's why I like to have tangible cash. Like, I'm not going to the store and buying stuff with my stocks, you know. I mean, I have those too. So you got to diversify. Yeah, I don't have Bitcoin. But I do have stocks, but that's not buying groceries.
Right.
Money is.
Well,
that I can go down the street and get out of the bank, which I did earlier today.
I think you make an important point. Having liquid, ready, available cash is always a good thing. It's nothing else. It's a peace of mind.
Yeah.
What we're talking about is someone that if they've got the proper time horizon, the long enough time horizon, that there is actually probably more risk associated with them sitting in cash or cash equivalents over a long period of time than there is them sitting in some type of productive asset. Now, that doesn't mean that if you just randomly pick a stock that it's going to do everything I just laid out here to you. I'm talking about if you did nothing more than buy index funds, if you looked over a 5-year period, a 10-year period, a 20-year period, or in this example in our radio show, a 50-year period, there's no comparison. The stock market valuation it's not even a fair fight. It has gone up not only to outpace inflation, but it also has outpaced the monetary supply, which those two things kind of go hand in hand. And it's left cash, the value of cash, in the dust. And that's where a lot of people, if any of you are listening and you're storing significant amounts of long-term money just sitting in cash or cash equivalents, it's worth having a conversation with your advisor. Again, per your risk tolerance, per your time horizon. Investing is not necessarily for everybody. One of the things we try to do with this show is educate you on what actually is really happening in the world of money versus what you might see the knucklehead Kramer say on TV or anything like that. This is what's really happening with your money. This is what's happening with the monetary supply. This is what's happening with inflation. And this is why, as long as you can stomach it, it's worth having a conversation about owning pieces of the stock market over the long run. Very good. Whew. That's a lot of data, isn't it?
Yes.
All right. Well, listeners, if you want to set up a follow-up conversation with the team at Gulf Coast Financial Advisors, it's very easy. You can call us at 251-327-2124. Find us on the website. That's gulfcoastfa.com. FA is in financialadvisor.com. On the site, there is a blue button in the upper right-hand corner that will put a meeting on my calendar. There's 3 choices. You can do a 15-minute introductory phone call. You can do a 30-minute Zoom. Or my preference, let's meet in person. Any of our 3 office locations. We're in downtown Fairhope. We're in what's called the Portico development off Fairhope Avenue. We're in Orange Beach. We're off Canal, just down the road from the wharf. And our 3rd office is in Mobile. It is near the intersection of Dolphin Street and I-65. However you reach out to us, make sure you do. We'd love to meet up with you, okay? All right, folks, coming up next, there's always been a lot going on in the world. So true. Particularly the world of finance, investments, and money. Every week we scour the internet for financial articles relevant to those of you in or near retirement. Then we give your honest opinion about these headlines. Join us after the break to hear Michelle and I discuss this week's relevant headlines in our News of the Week segment. Stay tuned.
A multidimensional financial services company, Providence Partners serves the needs of independent insurance, financial, and employee benefit professionals. The team at Providence Partners serves other business professionals like property and casualty agencies, registered investment advisors, community banks, and benefit brokers to assist in their clients' risk management planning. Whether an individual or business owner client, this planning includes income replacement protection, planning for extended healthcare costs, family needs, and generational transfers of wealth. At Providence Partners, we give you access to industry specialists. Those specialists focus on business succession, business owner planning, family and household protection, estate planning, planning for that income loss, or planning for long-term care solutions. Providence Partners is an Alabama-based company. We have offices in Birmingham and along the Gulf Coast. Our website is providencepartners.org, and you can reach us any of the working days.
Welcome back to Coasting Retirement. Your host, Josh Knoll, here alongside co-host Michelle Lee Milton-Knoll. So as we discussed before the break, every week we scour the internet for financial articles pertaining to those of you in or near retirement. Our job, or at least we tell ourselves it is to help you all understand how these headlines impact you, especially when it comes to your money. Now, quick note, if you want to read our referenced articles yourself, we do include the links in our show transcript, which you can find on the website, gulfcoastfa.com. Just go to the podcast tab, go to the episode that you want to listen to, and you'll see all the dialogue in the hyperlinks to the show articles. All that said, and without further ado, here's Michelle with the headlines of the week.
All right, Josh, as of right now, the entire financial world has its eyes on the sky. A massive headline just hit the desk from CNBC regarding the biggest initial public offering in history. It's titled, Morningstar Values SpaceX at $780 billion, less than half of its IPO target. Ruh-roh. As the article details, SpaceX has locked its upcoming NASDAQ debut at a fixed $135 a share, aiming for a staggering $1.75 trillion valuation to raise a record-breaking $75 billion on the sale of its IPO. The enthusiasm among retail investors is absolutely through the roof, but independent analysis of Morningstar just dropped a massive bucket of ice water on the hype machine. They put out a rare contrarian sum of the parts valuation, pegging the firm's fair value at just $780 billion. While they acknowledge that Starlink is a phenomenal high-moat profit machine, they warn that the public market is heavily overvaluing the company's recent artificial intelligence expansion and untested orbital data center tech. Morningstar's blunt takeaway for everyday people is simple. The stock is being priced for absolute perfection, and long-term investors should wait for the opening pop to fade before chasing it. So, Josh, from a wealth management perspective, we talk about this all the time, about the danger of buying a great company at the absolute wrong price. When you see a massive discrepancy like this between Wall Street's hype machine and the institutional fair value math, how should a retail investor dissect this headline? And what are the structural risks of buying into a mega IPO on day one?
Well, the first thing is if you, and there's no doubt that there's been a lot of questions around this. I mean,
I get it in my inbox every day.
Yeah.
Seriously. I don't even know that happened.
They've done a good job of marketing, that's for sure. And as opposed to most stocks or IPOs, I would say this is the one that I've been asked about the most. And I think that the big thing, and then the details we'll get to, the big thing is you got to know that if you're buying this, you're buying a story. Now, that story is that Elon Musk is one of the most dynamic creators of wealth and just one of the most creative business people that we've ever had in the history of mankind, and he's got kind of a golden touch. And to be fair, there is some truth to that. I mean, he's going to be the world's first trillionaire, and it's coming soon, right? But if you break down the individual pieces of this IPO, it doesn't look, the story kind of cracks a little bit. So, for example, most people don't understand, Michelle, Starlink is SpaceX is three basic components, right? There's Starlink, which is probably the most appealing part, one of the most appealing parts of the offering, because they I don't know how many thousands of satellites they have in space now.
I've actually seen that in the sky.
We've actually used it.
Yeah.
They're way ahead of the next. I mean, they're ahead by a multiple 100x over Amazon, which is coming up behind them. But Starlink, that provides satellite-based internet and other services, is so far out ahead, and they've got such a huge moat of anybody entering the business and catching up with them anytime soon. That's pretty appealing. But then you put in the rockets part of the business, which is very, very heavily capital intensive, relies a lot on government contracts, it requires so much money being spent that, at least as of right now, that is one of the money losing parts of the exercise. And then you have the third part, which is the dog, and that's the AI part. And what a lot of people don't know is, because he's good at this, he's really good at shuffling the deck. Musk sold XAI, had SpaceX buy XAI, because XAI is dogging, right? Mm-hmm. And they bought it for a huge valuation, which helped with the Twitter/X investors, kind of made them whole. But it saddled SpaceX with what is right now the run of the litter when it comes to AI. and even more funny, Michelle, I don't know if you saw in any of those things they sent you, the quantity of Tesla Cybertrucks that SpaceX bought.
You know what Wanda Sykes just said about that.
Yeah, we can't repeat that on the show. But they bought $135 million worth of or about $150 million worth of Cybertrucks. SpaceX did, right? So my point being is there's a little bit of Wizard of Oz going on here, right? Now, all that said, the market's irrationality will far outlive your pragmatism. Tesla has been an overvalued car company for almost its entire existence.
Yeah, it's like since its inception.
And there have been literally short sellers, that is, people that try to bet against the stock of Tesla that have gone belly up because Tesla just has sticking power, right? And again, a lot of it comes down to the power of story. Elon Musk is viewed as a visionary, right or wrong. I'm not here to argue that one way or the other, but you just have to understand that this thing is coming in out of. Let me give you hard numbers, right? If everything I just told you didn't jive or didn't make sense, when this comes in, they're valuing SpaceX at somewhere around 67 times sales. That's the total sales. Take that number, divided by however much they're saying the total market value is, 67 times sales, which is 3 times as much as another company that is considered pretty hotly valued, NVIDIA. 3 times as much, with a fraction of the revenue. In fact, I think, if I remember correctly, SpaceX is still, I think they had about a $5 billion loss in 2025, and then their first quarter was around $4 billion loss. Now, of course, they're investing a lot of money for you all that want to defend them. Fair enough. I'm just saying, my opinion, I think for most of our clients, we're saying, hey, let's see how this thing plays out. Now, there is a mechanism in place, Michelle, that wasn't in this article, but I believe that SpaceX is going to get added to the NASDAQ composite pretty quickly. I should have had this in my notes, but it's going to get added to a relatively major index pretty quick, which means that whether you buy this IPO right now or not, if you are a traditional index fund holder, like in a 401k or in your individual wealth management, more likely than not, at some point you're going to own a piece of SpaceX anyway, whether you want it or not, and that's going to help the valuation. So it's going to be interesting to see how this plays out. I would say. This is not the crystal ball part of the show, but I'd say there's going to be a pretty hot pop because we've been hungry for IPOs because basically private equity has kind of squeezed the juice out of the IPO market. So with this coming, I think there's going to be a lot of excitement, a lot of exuberance, and it'll probably pop for a while. But then, fundamentals always matter. The stock market is a voting machine in the short run. It is a weighing machine in the long run, and we'll just see if this thing holds water after a certain number of years. All right, what you got next?
Okay, for our next headline, we're shifting from the stars back down to terra firma, literally. We've got a piece from Schwab titled Gold versus Stocks, which is better inflation hedge. With all the talk about the AI economy, there's a quiet but persistent movement back into hard assets. Yay. The article tackles the age-old debate. When the cost of living climbs, where should you park your capital? It notes that while gold has the historical reputation of being the ultimate crisis commodity and a store of value when the dollar tanks, the data over the last several decades shows a different story for long-term growth. Stocks, specifically those in companies with high pricing power, have historically outperformed gold as an inflation hedge because businesses can raise prices to match rising costs, whereas gold just sits in a vault. However, the article emphasizes that in 2026, gold's role isn't necessarily about beating the S&P 500. It's about its low correlation to other assets, providing a volatility dampener when the market gets shaky. So we see this all the time. Clients get nervous about inflation and want to dump their paper assets for gold bars. So looking at the Schwab data, how do you help a client distinguish between a productive asset and a defensive one? And where does gold actually fit into a modern diversified 2026 portfolio?
Well, there's a lot of meat on the bone here, so let's take this a few pieces at a time, okay? First, you got to separate gold, the legitimate gold.
Keep them separated.
That's right. You got to separate the legitimate buying and selling of gold versus the scams. And we've talked about this on previous episodes,
we have,
right?
The scams, yes.
Yeah, the gold IRAs and
anything after 11 o'clock on TV.
Typically, right? And somehow it's wormholed its way into some of my YouTube stuff. But probably because I watch, anyway. And so the point being is you have to separate. If someone is telling you that gold is just the only thing that you should trust and put all your money into it, and here's the phone number to call a telemarketing organization and they'll take care of you, run way away from that, right? Not that stuff can't happen to stocks. You can just look at the penny stock phenomenon that was the crux of, what was that movie?
Big Short,
The Big Short. Yes. No, it was the other one. Oh, good grief.
Mad Money, something like that.
Right.
Mad Kitty, whatever. Yeah.
We'll come back to The Wolf
Yeah.
of Wall Street. Thank you.
Okay.
Yeah, that was a penny stock
stocks,
thing. Right.
yeah.
So all scams can happen anywhere. I'm just saying, for whatever reason, gold tends to attract a lot of scammers, right? So you separate those two things. Then you got to, again, gold a lot of times is sold as a story. I don't particularly have any strong feelings one way or the other as holding gold for investment as a small piece of the portfolio. My heartburn is when you react in, like Michelle said, you're reacting in fear and emotion, and you're thinking that if you can get out of these paper assets, these stocks and all that, and you can go 100% in precious metals, that your problems are going to be over. Maybe in the short run. I mean, that might give you some peace of mind, and obviously there is something to the physical presence of this and the time period that this stuff has been used. Although I can tell you, most of y'all investing in gold are not ever going to physically hold the gold that you quote unquote own, right? But this is a math-based radio show. And so we look at the numbers. And here's the numbers. So the show, we've been talking about the monetary supply since 1975 when I was born, way many years before Michelle was born, right?
That's right.
That's right. So if you look at, if gold is supposed to be a store of value that is to beat inflation, what that's saying is gold will retain its value while the dollar declines. Okay, fine. But if you look at the consumer price index, the CPI, from 1975 to 2026, the CPI went up around 466%. Got it?
Okay.
Gold.
CPI 466.
Right. Gold went up 3,258%.
Okay.
So that story has some legs.
Yeah, sure.
Here's the problem with that story. During that same period, the S&P 500 went up almost 7,000%.
Okay.
So this is pretty true. If you go back 100 years, as long as the stock market has been around and been fairly functional, while gold has not been a terrible investment by any stretch, it has historically appreciated in value roughly half of the overall stock market. That's pretty accurate across the board. And in more detail, it's not just the value that can be the problem. Losing that amount of value can be the problem for investors. What you're also not considering is stocks can produce profit or can produce dividends, which are profits distributed, right? Stocks have the capital appreciation like gold does. They've got way more, typically, they got way more liquidity. It's easier if I got a gold bar and I need to find a buyer, it's going to be a lot easier for me than if I got a share of SpaceX and I'm trying to sell it on whatever trading app I have, right?
Right.
Yeah, there's more ease of use. And you just don't have these other things being thrown off from productive stocks in ownership of companies with gold. Gold is not going to generate revenue.
Right.
It just doesn't, right? Now, the selling of gold, right, in the form of jewelry, that generates revenue. That company that sells that particular gold might generate revenue and have a good stock to look at. And there are gold and silver and all kinds of precious metal funds out there for those of y'all that want to dip into it without, having to go down to the, go down to wherever you buy physical gold. But
Well, go talk to those people.
down to the pawn shop. Yeah.
Well, the ones that are on the TV, they got it.
Oh, Lord, don't call those people. I'd rather you go to the pawn shop than call those people. So anyway, over the long run, it's just like with cash. Gold, if your two choices are sitting in cash versus gold, okay, fine.
Gold.
Yeah, gold. But if your two choices are sitting in most or all of your money in gold versus sitting in a well-diversified, educationally appropriately invested stock or investment portfolio, then there's no contest. It's over time, it's going to outrun the gold. All right, this is good.
Okay.
We got another one?
Yeah, we got one more, and it
Okay.
comes from our friend that likes to shop for clothes at Walmart like Josh does. But also, listeners, Josh and I shop for him clothes elsewhere as well.
Well, Michelle does, but listen. There's a T-shirt sold at Walmart by George.
You love it.
I love it's $5.98 for those of y'all that are hard on shirts. These things are indestructible, and they come in all different colors.
Well, they still stain because you stain them, and
do.
then you have to get
yeah,
more.
but if I got to replace them, they cost me $5.98.
There you go.
That is my hedge against some T-shirt inflation, Michelle.
There you go. Way to go. So anyway, you guys might know this is Stan the Annuity Man we're referring to, and it's an article titled The Truth About Inflation and Annuities. With inflation being the ultimate silent thief of a retiree's purchasing power, a lot of insurance agents use it as a fear tactic to sell products. The article tackles the common sales pitch where agents claim that they have the perfect annuity that automatically tracks or outsmarts inflation using indexed upside, or income riders. According to Stan, a commercial annuity that perfectly tracks inflation in real time just doesn't exist. You add a cost of living adjustment, COLA, rider for a fixed annual increase, but the insurance company will simply ratchet down your initial payout by 20 or 30% to make the actuarial math actually work. It can take 6 to 9 years just to break even. The article concludes with a fascinating point. The only true inflation-adjusted lifetime income stream you already own is Social Security. Instead of overpaying for complex hypothetical contract features, retirees are often better off pairing Social Security with simple contractual guarantees and tackling income gaps dynamically as they actually appear. So, Josh, when a client is terrified of inflation eroding their lifestyle, how do you help them see through the illusion of these inflation-friendly product pitches? And what is the mathematically sound way to build an inflation hedge without sacrificing their initial income floor?
Well, okay, so first, we must say this, because we reference Stan the Annuity Man a lot. We have no connection to him whatsoever.
No.
He just has, and the funny thing is, Michelle, he sells annuities.
Well, yeah, I mean, we've been to his website.
But he has really great articles, and this is a very recent article where he's
But he's not going to sell you Bobo annuities.
Right. I got to give it to him. If you're going to do the annuities, I think Stan the Annuity Man's got to figure out the lane to run, at least the lane that smells decent, right? So anyway, in this article, there's a couple different things. So one, Social Security. So regular listeners will recognize this statement. There has been, in the history of mankind, there has never been anything that has been effective at eliminating poverty in the elderly population than America's Social Security contract.
Thank you, FDR.
I mean, just period.
Yeah.
What that means, a couple of things is, one, it's very important, and two, we've got to figure out how to protect it and actually pay for it, right? That is
Right.
That's a conversation for another day.
When we get of that age.
But the Social Security, any of you all that are drawing it, or maybe you have people drawing, your parents are drawing it, whatever, you'll know that they do adjustments on it. They do inflation adjustments, cost of living, all that. And the annuity side of it, and we're not picking on annuities. The one thing that he does a good job of is he cuts through some of the buzzwords,
the fluff.
the fluff that are used to sell them sometimes. And as anybody, regular listeners know, our biggest aggravation with the annuities is just the way that they're sold, not the product itself. They're sold a lot of times in fear. If you're talking to an advisor and there's in the title of their company is safe, or sleep well, or what. I mean, if you have any of those, more likely than not, they're going to use annuity to give you that quote unquote safe.
Yeah, feeling. Yeah.
Well, the problem is, again, as we've just detailed, there's two primary problems. One is these things, as we've demonstrated before in the past on the show, they have a hard time keeping up with the market, and they have a hard time over a long period of time, and they have a hard time keeping up and outpacing inflation and doing the things they need to do. And then two, as Stan very well details here, is if someone's telling you that there is a inflation rider in the annuity contract, they're referring to an optional cost of living adjustment, which is not necessarily going to be based on the actual inflation that's going on when you trigger it. It's going to be based on a predetermined formula that may give you an increase, but it may have nothing to do with what's going on with actual inflation during a time period. And the trade-off a lot of times is that you're going to get a lower payout at the end of the day, because I'm telling you folks, more often than not, the insurance companies they're very good at this. They've been at this for a long time. This is a extremely profitable part of their business, how they structure these annuities, right?
Yeah.
Now there's always the case of you just live forever and ever and ever, and it works out on the income. But remember, we've not to beat a dead horse, but if you're looking at one of these things, you're looking for capital preservation and income production. If you're being sold that it's the greatest thing since sliced bread and it'll give you all of this upside potential with no downside risk or anything like that, and that it has all these inflation features and all that, give us a call and we'll walk you through that, what the actual language of the contract says, so that you can be better educated. And if that means that you're still comfortable with and it's what you want, that's fine. Again, we're not here to beat up on the product. We're here to bring light to the process and what these things actually do. Very good. Is that it?
That's it.
All right. Well, listeners, if you want to set up a conversation with us, it's very easy. Just give us a call, 251-327-2124, or find us on the website, gulfcoastfa.com. FA is in financial advisor. On the site, again, there's a blue button in the upper right-hand corner that will put something on my calendar. You can do a 15-minute introductory phone call. You can do a 30-minute Zoom. Or again, our preference, let's meet in person. We have 3 convenient office locations. We're in downtown Fairhope. We're in Orange Beach, and we have an office near the intersection of Dolphin Street and I-65 in Mobile. Make sure you reach out to us. Our folks, coming up next, Josh's Crystal Ball and Big Mouth would have been some of my predictions. Have I been right? Was I ever wrong? I was right this time, Michelle.
Yeah.
What I think is going to affect investors in the near future, maybe the distant future. We talk about all these things, poke a little fun at my big mouth. Stay tuned. Whether it's building a business from scratch with your own two hands and wanting to maximize the financial impact of those sacrifices, or growing a great nest egg by being a dedicated and reliable worker for years, or choosing to live a life well within your means in order to accomplish a lifelong dream of retirement, the last thing you want is to go with the wrong financial advice after you've worked so hard to accumulate your assets. You've also probably spent most of your life putting others' needs ahead of your own, and now it's your turn. We can help. Gulf Coast Financial Advisors is a locally owned, independent, fee-based financial planning, investment management, and tax planning practice. We have offices in Fairhope and Orange Beach. We serve all of Baldwin County and the Gulf Coast. We also have an easy-to-understand fee-for-service model with no sales quotas, no proprietary products. Our ultimate responsibility is to our clients' goals and dreams. You can reach us at 251-327-2124 or find us online at gulfcoastfa.com. That's Gulf, like the Gulf of Mexico, Coast, FA as in financialadvisor.com. Welcome back. Your host, Josh Knoll here, joined by co-host Michelle Lee Melton-Knoll. So I'm opinionated. I have strong opinions at times. I would say a radio show host that isn't probably would be very dull to listen to. So hopefully you liked what you've heard. And hopefully you voted for nappies, which I think the voting's over now, right?
It ended May 31st.
We don't find out till July sometime. But
really? That far away?
It takes a while, yeah.
Wow.
Yeah, they make us wait in anticipation. Did we win Best Lifestyle Radio Show? We'll find out. Also, I'm paid in my profession to offer professional guidance and opinions to my clients. So I like making predictions. Sometimes I hit the bullseye. Sometimes I swing and miss. Let's see what we got here with Josh's Crystal Ball and Big Mouth. What you got, Michelle?
All right, Josh. Regular listeners might remember that back when Dogecoin and the Department of Government Efficiency, or Doge, which I can't say without laughing, were going full force, you took a lot of heat for calling it a complete waste of time. Your point wasn't about the technology, it was about math. You stated that the only way an efficiency commission would work was to tackle the actual components of the parts of the federal budget that actually mattered, such as Social Security, Medicare, and defense. But then no politician was actually going to have the guts to touch what is referred as the third rail of American politics. Yes. While Doge initially claimed it saved taxpayers hundreds of billions of dollars, nonpartisan fact checkers and budget analysts estimate the true verifiable savings are much closer to $1.4 billion to $2.3 billion. I'm actually still kind of surprised by that, but grateful to hear it. I hope it's real. So all appearances are that you got the prediction right, but if so, why do you think it's so hard for Doge, or any group for that matter, to cut federal spending?
All right. So for those of you all that are listening that were fans of Doge, we mean there's no offense. We are a non-political show.
No,
we are
not
a math show.
Yeah.
And if you want to understand why Doge, by most measures, did not do what it intended to do.
I just think of Elon with his antics, though. That's what cracks me up, though, his animation and stuff.
He's something.
Yeah.
Well, if you want to understand why Doge didn't do what they set out to do, you have to look at how the federal government actually spends our money. In any given fiscal year, the federal government spends around $7 trillion. The public has the illusion that the spending is on corporate welfare or foreign aid or bureaucratic waste. And to be fair, there is some of that.
Yes, there's definitely some of that.
But the hard reality is our budget is overwhelmingly dominated by just three things. And Michelle touched on them: entitlements, defense spending, and sadly, the interest on our national debt. So let's break down the math real quick, okay, Michelle?
All right. Social
Security is the single largest line item.
Yeah.
And we talked about that earlier, how important that is. It is roughly 22% of the entire federal budget. Got it?
Yeah.
Healthcare, which would be Medicare and Medicaid, they take up around another 28% of total spending.
Okay.
National defense, that's about 13% on average of the budget. of the budget. And then the interest on our national debt, this is the scary one. It is right now 14% and growing.
Yeah.
So if you do quick math, you all that are good math in your head, those 4 categories, you're already over 75%, pushing 80%. The rest of what the government does, like building roads, bridges, education, national parks, NASA, all that
Education,
other stuff.
no big deal. It's
Right. That's all crammed into the tiny
Infrastructure,
sliver.
who needs it?
Yeah, those 4 things I just told you are the majority of the federal. Now, it's obviously more complicated than that, but in broad strokes, that's how it works. So that brings us to why do we run a permanent federal deficit? Or why do we run a federal deficit for so long? Because it's a math trap. Again, this show's about math. Right now, the current projection of our national debt for this, our annual deficit this year is around 1.9 trillion. What that means is we're going to take in somewhere around 5 trillion in income and tax receipts.
Yep.
We're going to spend
And
7.
spend more.
Right. And how you cover that is very similar to how you would do it in a household where you'd break out the credit card. The government issues debt. We talked about that in the opening segment, right? Well, if you do that in 1 or 2 years, okay, right? Maybe you're trying to get the economy going again by deficit spending. That's why that's done. But when you do it year after year after year to now to the tune, I think we're somewhere in the high 30-ish, 35 million in total national debt. Well,
35 million?
35 trillion.
I was going to say,
Thank you.
35 million, I'm not worried about. 35 trillion, yes.
So the interest on that 35 trillion is now up to almost 15% of our total budget. That's tough, right?
Yes.
So here's how it, in summary and closing the show, here's how it applies to your you listeners, or your retirement and your investment accounts. So combined, all of that entitlement spending, all that is greater. All that is now greater than the total tax revenue the United States brings in. That means before Congress even opens up a single debate about funding the military or running the government, all that is done right now on borrowed money, right? And that leads us back to the theme of the episode. When you are creating debt, creating loans through various mechanisms, when you're creating an increase in monetary supply, that means that there is more money to buy the same amount, sometimes lesser amount. It's rare that the amount of goods and services being produced will radically accelerate to keep up with the increased monetary supply. So what happens? The assets that have some type of intrinsic value, i.e. stocks, real estate, even gold, to be fair, this money, this excess money, just think of the amount of people. You're running a race and you all are chasing the same thing, which means that the value of those things which have a limited supply versus a nearly unlimited increase in supply of money, it means that the value goes up over time. It's math, right? Okay. All right. Well, listeners, I hope you enjoyed a little peek behind the curtain. The
Wizard of Oz.
Yes.
Everybody look into that. It's really interesting.
I'm going to look at it in a different way now.
Yeah.
We invite you one last time. Give us a call. Set up an appointment, 251-327-2124. Go to the website, gulfcoastfa.com. Find us at any of our 3 office locations, Fairhope, Orange Beach, and Mobile. That is our show for the week. I want to give a huge thank you to my co-host, Michelle Geishav.
Yay, you're welcome.
All right. Thank you to our producer of the show. That's my son, Peyton Knoll. Thank you to our show sponsor. That's Providence Partners and Mr. J. Stubbs, and maybe Walmart. You think Walmart's sponsoring this one? They should send me some money for my George T-shirt
They should.
plug. That's right.
Or just a lifetime supply.
$5.98, all the colors. Thank you to our awesome radio station. That's FM Talk 106.5 out of Mobile. Many thanks to the provider of our show music. That's local band and Michelle's favorite animal, Sloth Racer. And as always, my sincere appreciation for all you out there that have been listening and joining us on this journey. We'd love to be a part of your journey as well. Until we talk again, have a wonderful and productive week. This has been Coasting in Retirement with Josh Knoll. Gulf Coast Financial Advisors, LLC, known as GCFA, is a registered investment advisor offering advisory services in the state of Alabama and in such other jurisdictions where it is registered, filed the required notices, or is otherwise excluded or exempted from such registration and or notice filing requirements. Registration does not indicate or imply that GCFA has attained a particular level of skill or ability, nor does it constitute an endorsement of the firm by the Securities and Exchange Commission, the SEC, or any other state securities regulator. The Coasting in Retirement radio program serves mainly to disseminate general information, including those pertaining to GCFA's advisory services, together with access to additional investment-related information, publications, materials, and links. The publication of this radio show should not be construed by any client and or prospective client as GCFA's solicitation to effect or attempt to effect transactions in securities, nor should be interpreted as GCFA providing personalized investment advice or any type of professional advice for compensation wherever this program is broadcast. Any subsequent direct communication by GCFA with a prospective client will be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. Certain information, news stories, headlines, data, charts, graphs, figures, or statistics presented on this radio program may have been obtained from third-party sources that are believed to be generally reliable, but which GCFA may not have independently verified. GCFA does not and cannot guarantee the timeliness, accuracy, or reliability of any such third-party information and undertakes no obligation to update or correct any information that may become obsolete, unreliable, or inaccurate. This radio program also contains the opinions, views, and perspectives expressed by Josh Knoll and any other GCFA representative, which are solely their own and do not necessarily reflect the opinions, views, or perspectives of GCFA as a firm. Such personal views and opinions should not be construed as endorsements or professional advice from GCFA. GCFA makes no representation or warranty regarding the accuracy, completeness, or reliability of any information on this radio program and disclaims any liability for any direct or indirect loss or damage incurred from using or relying on such information. GCFA and Providence Partners are not affiliated, nor are any of their respective representatives.